So again, thank you everyone for joining us for financial planning, a roadmap to your retirement. The goal of our presentation this evening is going to be to talk about the various components that go into the financial planning process and to assist you, our membership, in turning your life's aspirations into financial realities. So, my name is Whitney Bullock, and I'm the financial planning manager here with Kinecta Wealth Management. I have over 20 years experience in the financial services industry. Again, manage the financial planning area and am a LPL registered principal with the firm. So when we think about financial planning, we really focus on six main areas. And the first area that we talk about is cash flow management. And this really refers to just being very cognizant about the money that you have coming in versus the money that you have going out. So if you are experiencing a negative cash flow, that indicates that you have higher spending. And subsequently, when you have a positive cash flow, this means that you're saving more. So we also, cash flow management, another component of that is just understanding your net worth. So what you owe versus what you own. And so, assets minus liabilities, giving us your net worth. Risk management is another component that we want to look at when we think about financial planning. And this is the potential threat to financial stability and your retirement income. So we want to use solutions like long-term care insurance or life insurance, health and medical insurance to make sure that we mitigate against some of these potential threats during retirement. Investment planning, this is something where, we do have a team of financial advisors. They're assigned to each one of the connected branches. So they're available to work with you on investment planning. And this allows us to understand, what your risk tolerance is, to take a look at asset allocation, tax implications, and diversification. And then we also want to consider tax planning strategies. So is there a need for tax reduction strategies, tax deferred investing, qualified investment? Qualified investments, or if you are a business owner, taking a look at what is the best way to set up your business so that you have the best tax strategy. Retirement planning, this being one I'm sure we're all familiar with, where we're going to look at, a 401k, a 403b, IRAs. When you work with me, part of what we do is a Social Security analysis. So we want to determine the best age for you to start Social Security and generate that income, looking at Medicare and Medigap expenses, and then Roth conversions, as well as any tax transitions that may be a good strategy for your retirement plan. And then lastly, but equally as important, is estate planning. And so that's where, we just want to ensure that you've got a trust or a will put together, that you do have a healthcare directive put together, power of attorney if needed, special needs, if you have special need dependents, minor children accounted for. And then if you are a business owner, we certainly, and you're getting ready for retirement, want to take a look at what succession planning looks like. So when we think about financial planning, before we get into the actual financial planning process itself, where you see what the plan looks like that will be made available to you, our membership, is financial well-being. And so there's six key areas that we focus on here in terms of financial wellness, because it really is more than just finances. So, first we take a look, of course, at personal finances, right? And again, that's just that cash flow management. And that could be things also like ensuring that you have your bill pay set up with an automatic process, right? So that you don't have to sit down and write checks every month. You just have it set up. Bills are being paid. If you're contributing to your 401k, that all of this is done automatically. If you have children, that you're putting money aside for educational expenses, that all of this is just sort of being done automatically. And then, of course, having a real grasp on what your net worth is. And then we talk about goals. And this is something that we spend a lot of time during the financial planning process, is wanting to understand what your goals are. So when you think about retirement, you can be as You can plan it as big as you like or as moderate as you like. But for many people, that's going to be building in expenses like home improvements that may need to be done, travel that people want to, trips that you want to take. This could be planning for a child's wedding or educational expenses. And then if you have goals outside of your financial goals, we want to take a look at that as well. And that could be hobbies that we want to build in expenses for. And then third, we talk about wellness. And this is something to really take into consideration when you think about retirement, because for a lot of people, this is a very big transition. And so you want to think about how to create a lifestyle where it fosters both health and wellness. So we know how important our financial goals are, but we also, want to spend time thinking about what are the hobbies that you enjoy, or maybe things that you haven't had an opportunity to do while you're working that you'd now like to pursue. So for a lot of members that I work with, there's definitely wanting to put aside money for golf. It could be tennis, gardening, volunteering in your community. Um, Ensuring that you get enough exercise and rest. So that's super important in terms of wellness. And then ensuring that you have time outdoors. So, all of the scientific studies show how, our overall wellness and health and happiness is improved by spending time outdoors. So just being intentional about how you're using your time so that you have the most fulfilling retirement. And then next, we talk about retirement, and so just knowing that you've saved adequately to support the lifestyle you want in retirement. And this does include healthcare costs, which we'll touch on shortly. Family is just, creating a supportive life for yourself, and family can mean different things to different people. So this could mean your biological family as part of your support system, or it could be friends or people in your community that you spend time with, in activities that you enjoy. So just ensuring that there's that support structure there for you. And then lastly is security. And that's just a feeling of financial safety when you look into the future, that you've invested well, you've saved adequately, there's an emergency fund, you've got insurance to mitigate against loss, and just all of the components that fall under financial stability. So that's what we want to help you achieve and feel confident about. And that's the wonderful thing about a financial plan, because it really does give you a roadmap that you can visually see and supports your overall goals. So when before I jump into introducing you to Katie and Alex, who is the husband and wife who are looking to retire this year, and we want to determine whether they can retire. And so they've asked to put a comprehensive financial plan together. And what you're going to see today is something that's available to you as a Kinecta member. But what I want to touch on just quickly when we go into retirement, there are four important risks that we want to consider. And this is where a financial plan helps us to solve and analyze for these risks. So the first is longevity. And that's just the understanding that we are living longer than we have ever in history. And we need our assets to last longer through retirement. Inflation is another area. So I meet lots of people who are really good at putting their Excel spreadsheets together, and they know what money is coming in and what money is going out. But we know that today's dollar is not the same as what a dollar is going to look like 10 years from now. So we've got to build in inflation. And so one of the things that you'll find in the financial plan as we move forward is that we're building in inflation for expenses, and then we're also building in cost of living adjustments for Social Security. The third element that you want to consider is incapacity. And this is a really important one in terms of just thinking through what source of funds would you use if you were to experience a long-term incapacity. And one of the things that I want to share with you is that, as a Kinecta member, we have a financial planning department. And so we do have an insurance specialist who's a part of our team. He specializes in long-term care. And so one of the things you can do through this planning process is just get an educational overview of what that cost looks like in your actual city. So it's really nice. We can, bring it up to analyze it at the city level. And you can take a look at, if I needed someone part-time in the home, or if I needed someone full-time, or if there was an assisted living situation, or the larger expense being something like a nursing home. But we can show you what those expenses look like and then offer some solutions that can help you to preserve your retirement income and the assets that you've saved. And then lastly, which we're all fairly familiar with, is the sequence of returns. And that is, what if I retire in a year when it's a down market? So it's something to take a look at, in terms of when you decide to retire. Because if we do retire during a down market, taking withdrawals and drawing down on our portfolio can have an impact on how long those assets last. So again, these are just 4 risks to consider, and we're going to examine those as we go through the financial plan. So, excuse me. So with Katie and Alex, I just want to introduce you to them here. You can see they've got children, and they've provided very well for them. They are now 63. Alex is 63, making 150,000 a year. They're both they're married, reside in California. Katie is 62, making 80,000 a year. So when we look to develop your financial plan, what is really important to us is to understand what are your needs, your wants, and your wishes. And so when we talk about needs, that's really looking at what are your basic living expenses. So for Alex and Katie, they spend about 77,000 a year in terms of their basic living expenses. And you'll notice here I've built in a base inflation rate of 2.5%. Don't be alarmed by that. We certainly know that over the last 2 years, we have seen inflation much higher than that, even pushing upwards of 8%. But when we look at a national average and we look at a duration of, let's just say, 30 years, for example, in retirement, it tends to average about 2.5%. If that's something that you're uncomfortable with and you want us to measure your financial plan with, let's just say, a 4% rate, inflation rate, we can certainly do that just to stress test it in different ways. Then we also, Alex and Katie have thought through putting money aside for healthcare. So they're putting 12,000 aside annually for healthcare. And this expense we are growing by 4.25% because healthcare tends to have, those expenses tend to grow a bit more. And this is something that, potentially they could use towards long-term care insurance if that's something that they wanted to do, or it could be money that they use to supplement their Medicare with maybe a Medicare Advantage plan, for example, if they wanted higher levels of coverage. So, but they've already got that kind of thought through and factored into their plan. And then we jump into wants. And I find this very often, once you're ready to retire, there's a, real excitement over let's do some home improvements and make the house really nice because we're now going to be here, more often. And so for Katie and Alex, they want to do a bathroom remodel. So they've set aside 18,000 for that. They have factored in a new car, which they're going to pay, 35,000, and they've factored in doing this 2 times during retirement, so every 10 years. And this is something, of course, we always recommend that if, we're in an environment where interest rates are really low, you may want to look at financing that versus taking 35,000 out of your investment portfolio to pay, cash for it. But if we're in an environment like we are right now, it probably makes more sense to, just pay for this outright. They also, are super excited about the opportunity to travel. So they're going to travel for the next 15 years, and they've set aside 10,000 every year for travel. They also are, they've decided to go ahead and allocate a certain amount of money for their daughter's wedding. And so they've got 2 years here. Again, we're building in some inflation for that, but 35,000. And then just taking into consideration, some of those things that just seem to come up every year when you're a homeowner, where there's going to be these extra expenses. So they just put down, 4,000 a year, and then, we'll grow that again. But 4,000 a year just allocated towards, whatever sort of home improvements may be needed. And so when you think about your, needs, wants, and wishes, just know that we can design this for what is specific for you and your family. Sometimes I have people who would really like to build in their hobbies. So I had someone recently who wants to, learn how to fly planes. And, we have people that want to do some bigger trips, for example. So we can factor all of that in and just ensure that we do a stress test on the plan to make sure, regardless of market conditions, that you'll be able to do all of the things that you want to do in retirement. So we also, during the planning process, want to get to know you better and also have you think through, what are your expectations and concerns for retirement? And it's really fun when you have two spouses because they very much could have really different ideas about what they want to do in retirement. So it's a great conversation piece and just helping, the couple to kind of decide what we can design this, what do we want it to look like? And we want it to be the best time of our lives. So in this case, for Katie and Alex, they want an active lifestyle. They want to travel, spend time with their friends and family. They definitely are interested in volunteer work, and there's a possibility that they'll move to a new home. So, in that idea of moving to a new home, I just want to let you know that part of what we can do during the planning process is if you're considering moving out of state, for example, so I had a member and his wife yesterday. They're considering moving to Kentucky. And so they wanted me to run a financial plan for California as well as Kentucky so we could take a look and compare the state taxes. So just know, where if you have any plans for moving out of state, we can run so that you can see the federal and state, but more specifically the state marginal tax rate, and just see what's going to be more advantageous for you and allow your retirement savings to last you longer. And then on the other side are concerns. We want to know what are the things that keep you up at night, because those are the areas that we really want to address. And as financial advisors, here at Kinecta, this is where they want to spend their time focusing with you to ensure that you are feeling confident and comfortable in your retirement. So many retirees, right, we're concerned about running out of money because we're no longer receiving a paycheck, suffering investment losses, the cost of healthcare, long-term care, always a big one, leaving money to others, spending too much, and current or future health issues. So these are areas that we can address during the planning process. So whatever your concerns are, you can just bring them to the table as we talk through it, and we're going to make sure that we can come up with some solutions for you. So as financial planners, we love to have these nice colorful graphs. And so this is just a graph that's going to show you your net worth summary. So in the case of Katie and Alex, they have saved 620,000. So that is what they have saved. The other asset, the 750,000, that's the current market value of their home. The market value of their home is not factored into any of the cash flow analysis. That's just something to show total net worth. They do have liabilities, which includes a mortgage and then a little bit of consumer debt that's about 240,000. So when we take their assets minus liabilities, they've got about 1,130,000 in net worth. So then what we're going to do is we're going to put a resource summary together for you. And that is going to be a nice 1 to 2 page summary that's going to show you where all of your accounts are held. So if you have any beneficiaries or children that you want to share this information with so you can kind of show things all in one place, this can be a helpful summary. But it will include 401ks, your stock accounts, checking accounts. Alex and Katie here have a Roth and a traditional IRA. And then because they're both still working, they're contributing to their 401ks. So we'll continue to show those assets coming in and growing their 401k plans until they decide to retire. And then again, down here, just showing the current market value of the home. So they do have a little bit of term insurance. So we've got that kind of listed up here. Social Security, they both decided that they're going to take it at their full retirement age, which typically is 67, but based on their birth dates, it's just a little bit before 67. And so Alex is going to be receiving $37,800 annually, Katie $31,500. And this, again, we use a cost of living adjustment. So when I get to the cash flow analysis shortly, you'll see Social Security growing by 1.5%. So that hopefully, it doesn't quite keep up with inflation, but it's a little bit of help. Alex is fortunate to still have a company pension. He will be receiving $15,000 a year until the end of his plan, and then if he predeceases, Katie 100% will go to her as the survivor. So right now we can see they've got two income sources that are going to come into the plan. So both Social Security as well as this pension income, and then below here we're just showing the couple of liabilities that they have. So one of the things that we talk about when we go through the financial planning process with you is, and this, what you're looking at here in terms of these model portfolios is really just meant to be a high level conversation about risk. We want to understand what your risk tolerance is. And we know that for most people, we are more growth oriented when we're working, right? So this green box here shows the way Katie and Alex are currently invested. So they have about 76% in stocks, 16% in bonds, and 8% in cash. And what we're going to do, just to err on the side of being super conservative, is we're going to say, okay, once you reach retirement, let's give you a risk tolerance of capital preservation one. It's going to have a projected rate of return of 4.27%. And so I'm going to run that as the projected rate of return through the life of the financial plan. And the reason that we do this is because if you take any model portfolio and you look at it over a 20, 25-year time frame, it's going to have an average rate of return. So you're not going to see the highs and the low and the highs and the lows that are happening on the back end. You're just going to see an average for these asset classes over time. So we build in a pretty conservative, 4.27. Again, standard deviation over here is really just a measure of risk. And so the higher the standard deviation, the greater the risk, but typically the greater the reward as well. So you can see the way they're currently allocated. I'll just round up and say, they've got about a 6% rate of return, but definitely a bit more stock exposure, so more risk involved there. And again, this is not an investment recommendation, but this is just a conversation around understanding your risk and then building in a projected rate of return to stress test your financial plan. So when we do and many of you may be familiar with this concept, with your 401ks, is we will do a Monte Carlo stress test. And what that is doing is looking at 1,000 different market conditions historically, or we'll say 1,000 different retirement scenarios. And so those can be, years when the market is up and years when the market is down. And it's asking the question. So this is the way that Alex and Katie are currently allocated with the 76% in stocks. This is us becoming a lot more conservative in retirement and going in this capital preservation one. So with the stress test, it looks back and says, okay, you put these different goals into the financial plan. What is the likelihood or the probability of success that I will be able to achieve all the goals that I've built into the financial plan and not outlive the money that I have saved or the income that I have coming into the financial plan? So you can see here, by becoming more conservative, they have a higher probability of success. And so this is where, your investment management and working with a financial advisor becomes very important, just to be sure that you've got this, a lot of oversight over your investment management. And one of the things we also do when we talked about the sequence of returns is we're going to do a bad timing stress test. And so that's what you see down here below, where it says, let's just say hypothetically, if they were to retire this year, and which we've certainly experienced some down days this year, but it'll take a look at what if we have bad returns this year and next year. So that's that sequence of returns. What would be the impact on the plan? And so you can see by having more equity exposure, that could look like being down by about 25% versus, say, 12% if you were in something more conservative. Again, you never have losses unless you decide to sell, but this just gives you an idea of what you can kind of tolerate in terms of market conditions. And if you were to see a drop in your account, what percentage would you be comfortable with, and then what percentage would cause you not to be able to sleep at night and call your advisor and say, I need to come out of the market, or become very emotional around it. So we want to understand that, so we're sure that we're investing properly for you. And so this particular slide is one that our members really, really value in the financial planning process. And this is where we're going to take a look at your retirement distribution cash flow. And this is where all the numbers come together. And I hope you can see this okay. But the top part here is all of the income coming into the financial plan. So when Katie and Alex first retired, we've got this line item with pension across here. And then Alex is going to start Social Security next year. And then, Katie will have it coming in 2026. So you can see the line items across here. This is all the income coming into the financial plan. And then we jump down here into the middle. This is going to be all of the expenses. And you can see, even with the basic living expenses, starting at 77,000, the next year it's 78,325, that it is increasing with inflation every year. Now, here you'll notice a big drop. So from 82,000 to 59,000. So one of the things that I can build into your financial plan is if you plan to pay off your mortgage at some time, during your retirement, we can plug in that year that you're going to pay off your mortgage. So for Katie and Alex, by the end of 2027, they have their mortgage paid off. So the following year, their basic living expenses drops. So, and if there's any other, liabilities that you have that you want us to back out of your expenses through retirement, if you have maybe a vacation home or a rental property or something, even a car loan, we can back all of that out. So, below here, we are going to take a look at the total outflows in the account. And then, we're taking a look at taxes. The way that the software works is we do spend your taxable assets first and then go into your qualified assets. And this is just a way to keep your federal and marginal tax rates lower, because many people are spending more those first couple of years of retirement. So we will spend the money that you've already paid taxes on and then look to go into the retirement accounts. So for Katie and Alex, they start with a portfolio. So what they have saved in total is 620,000. So that's their investment portfolio. But they've got their pension income up here and Social Security. So when we basically take the income coming into the plan and subtract it from the total expenses, and that lets us know what our deficit is, or what we're going to have to go into our investable assets, what we're going to have to pull in order to fund our expenses. So in this case, even with the 4.27%, this line item here is their investment returns. So you can see that across the bottom here. So that, that $22,570, the investment earnings for that first year on the 620, the difference between their expenses of 92,000, you see, it kind of offset by the investment returns. And then the next year they're at 550,000. So we can go through that, analysis with you. And then at that point, we also take a look at, what are the federal and state marginal tax rates? And this is where it gets, really interesting, especially if you want to move to a different state. For Katie and Alex, they do stay in a fairly low tax bracket. This particular chart does not show their required minimum distribution starting yet. As many of you may know, with the CARES Act, that Biden signed in December of 2022, um, the age for the required minimum distribution increased to 73, and then depending on your birth date, it may be 75. So that gives you a little bit more time before you have to start going into your retirement accounts and paying taxes on those assets. So we'll examine your federal and state marginal tax rates. A lot of times there's opportunities if this happened to be like 25 or 30% or 32%, for example. If we see it that there's higher expenses that are pushing you into a higher tax bracket, we can analyze that and see how we can kind of spread out the expenses to keep you in the lower tax bracket. So there's a lot of tools that we can use to help you kind of mitigate the situation with taxes in retirement. And then lastly, we just want to think about as part of the financial planning process, the best ways to interact with the next generation. And so that could be, depending on your comfort level, with your children and how much you want them involved, or if you have, friends or a trusted contact, that's somebody that you want to bring into your financial situation. It can be great to bring them in for annual reviews just so they get to know your financial advisor. What out of this list here, I think the most important one that I really like to focus on with members, and I don't know if any of you've had experiences like this with your own parents, but is organizing your important documents. So I know with my parents, I really focused on, we need like a specific area where, powers of attorney, healthcare directives, trust, will, all bank account information, it's kind of all in one place. And that way you just create, a very nice opportunity for whoever is going to assist you should you need it later in life to be able to go to one place and pull all that information and then support you in the best way possible. And so, lastly, we just, want to think about kind of money as being more than just, you know, finances, or money is for life and life isn't for money. So this is just basically getting to that overall picture of what retirement looks like. Like we really want it to be a time where you are able to do the things that you really dreamed of. And having a financial plan will give you that roadmap to make sure that you can do all of those things. It's a document that is a living, breathing document. So we don't want you to think that it's something that you do just one time. We want to update it for you annually. Anytime you have a major life event or you've got some ideas, you're thinking about, buying an investment property, or you want to do some renovations, or maybe just, taking a look at whether you want to move to a different state, you can reach out to me or to your financial advisor and we'll get together and we'll just rework the numbers. But, it's really a wonderful opportunity for you to be able to have this as more of a science than just something that you're, kind of hoping that it all works out. We want to make sure that we've designed something for you that you feel confident. I'm going to have the retirement that I want to have.